Intel, one of the biggest semiconductor stocks and possibly a very controversial one, just reported their earnings on 27th of April and the stock price rose more than 5% post-earnings call. So does that make Intel a buy today? So in today's video, I'll be breaking down Intel's Q1 2023 earnings call to try and answer the question, should we invest in Intel today? So overall, Intel did $11.7 billion in revenue for Q1 of 2023. This represents a 36% decrease year over year. So you may ask, why did Intel stock price rose after a huge decrease on year over year revenue? This is because we are currently in the largest semiconductor downturn since 2008, and Intel has already warned us about this huge drop in revenue. In fact, analyst expectation of Intel's revenue sits at only $11 billion. So the fact that they managed to beat this expectation is probably the reason as to why Intel's stock price rose by more than 5%. Now looking at the breakdown of Intel's business unit, you can see that the client computing group is down 38% year over year, data center and AI is down 39% year over year, and the network and edge is down 30% year over year, with only Mobile Eye being the only business unit that has an increase of year over year revenue, and Intel Foundry Services, which is one of the business units that Intel places a lot of emphasis on, is down 24% year over year. Jumping over to the prepared remarks by CEO Pat Gelsinger, we can see that Intel is still laser focused on delivering their IDM 2.0 strategy, and CEO mentioned that Intel is driving consistent execution across process and product roadmaps and advancing their foundry business to better position Intel to capitalize the $1 trillion market opportunity. Okay, so I'll be taking a look at Intel's Q1 2023 financial highlights before moving down to their revenue breakdown by business unit. So as mentioned, Intel's revenue for Q1 sits at $11.7 billion, which represents 36% decrease year over year. And both gross margin and EPS both took a hit, so gross margin sits at 38.4%, it's down 14.7% year over year. And EPS sits at negative 4 cents, meaning they make a loss of 4 cents. It's down 105% year over year. Despite this very negative news, there is actually a silver lining coming out of Intel's Q1 financial results, and that is slightly above their January outlook. So for revenue, you can see that it's actually $7 billion above their January outlook, and for EPS, it's actually 11 cents above their January outlook, meaning to say that they actually expected more losses for Q1 of 2023. So moving on to Intel's revenue breakdown by business unit, we have the first business unit, the Client Computing Group. So for the Client Computing Group's revenue is down 38% year over year, dropping from $9.3 billion to $5.8 billion, and their operating income is down 81%, dropping from $2.7 billion to $0.5 billion. So this is probably not very surprising, as we are in one of the largest semiconductor downturns since 2008, and memory players like Micron have already reported their earnings for this quarter. So for Micron, their operating income is in the red huge negative, so I'm a little bit surprised to see that Intel still maintain a slight operating profit. And notice that they made similar comments that the revenue is down mainly attributing to the OEM inventory reductions and operating income is down, and a huge part of it is because of excess capacity charges. Okay, moving on to the next business unit, the Data Center and AI business unit. So similarly to the Client Computing business unit, the revenue and operating income for the Data Center and AI business unit is down significantly. So revenue is down 39%, dropping from $6.1 billion to $3.7 billion. And operating income is down $137 billion, dropping from $1.4 billion to a negative $0.5 billion. However, there's a caveat to this, and that is that this is the first quarter that Intel is including their GPU segment in this business unit. Intel's GPU business is still in its infancy and currently making a loss. A lot more research and funding will need to go into this before they will be able to compete with their biggest rival Nvidia on a similar level, and this could probably explain why the data center and AI business unit is currently making a loss. If it's not for the GPU business unit, I believe that the data center and AI would have made less loss or flatline like last quarter, and both AMD and Nvidia has yet to report their earnings for this quarter. So if we want to verify if what Intel said is true, that a portion of this drop in revenue is due to a contraction in total addressable market, we will need to wait until AMD and Nvidia report their earnings for this quarter and do a comparison between these three companies. Okay, moving on to the next business unit, the Network and Edge business unit, we can see that revenue is down by 30%, dropping from $2.1 billion to $1.5 billion, and operating income is down by a whopping 172%, dropping from 416 million to a negative 300 million. So the reason that Intel gave for this drop is due to high inventory by customers, and this is pretty much in line with the memory players, again Micron. Micron also stated that the main reason why they are seeing a huge decrease in revenue and operating income is due to inventory surplus by their customers. Okay, moving on to the last two business units of Intel, Mobileye and IFS, Intel Foundry Services. Intel has actually already spun off Mobileye into a separate company, as it is in the EV market and has nothing to do with Intel's IDM 2.0 strategy of being a semiconductor powerhouse once again. I believe that the Mobileye acquisition was made by Intel's previous CEO before Pat Gelsinger took over. However, it is still included in Intel's quarterly reports, as Intel still has a very large stake in Mobileye. Now, as part of Intel's IDM 2.0 strategy, Intel placed a lot of emphasis on their IFS business unit, even though currently it represents a very small amount of their revenue. So for the IFS business unit, revenue saw a 24% decrease year over year from 156 million to 118 million, whereas operating income saw a much bigger drop from negative 23 million to negative 140 million. So this is pretty much in line with what we see from other foundry businesses like TSMC and UMC. So TSMC saw a 15% drop month over month, and UMC saw a 14.5% decrease on their revenue quarter over quarter. Intel will still need a lot more capital investment, even with the help of the CHIPS Act, and probably another 5 years before Intel Foundry Services is able to contribute meaningfully to Intel's revenue and bottom line. For the last part of Intel's earnings call, they actually provided us an outlook going into the future. However, notice that this outlook is only for Q2 of 2023, and they did not provide any outlook for the whole year of 2023. So looking at the Q2 outlook, it's actually better than Q1 because revenue is projected to be between 11.5 billion to 12.5 billion, and gross margin is projected to be 37.5%, and EPS projected to be negative 0.04. This signifies that this is probably the bottom for the current semiconductor downturn cycle, and we may expect a modest recovery in Q3 and Q4 of 2023. So I'll be keeping my eyes peeled for the Intel's next earnings call, where they'll probably be providing an outlook for Q3 and even Q4 or even the whole year of 2023. So before I end off my video, I want to talk a little bit about Intel's free cash flow and dividend. So Intel's free cash flow for this quarter is at negative $8.8 billion, down 257% year over year. This is probably due to their expansion plans when they need to put in a lot of cash. So they have already slashed their dividend and may continue to slash their dividend or even cancel this dividend because they need to put in a lot of money to execute on their IDM 2.0 strategy. So to conclude, Intel has taken the right steps to execute on their IDM 2.0 strategy. However, they still have a very long way to go before they can gain back their former glory as a semiconductor powerhouse. So this is a turnaround story, which means that if you want to hold on to the stock, you will need at least 3 to 5 years before you can see a meaningful change to their fundamentals and stock price. However, as long-term investors, we should look out for their execution on their IDM 2.0 strategy, so things like if their products are competitive and whether or not they'll be able to grow their IFS business unit. Overall, for 2023, it is a show me what you can do kind of year. I will evaluate their execution at the end of 2023 before deciding if I want to add more shares of Intel. So that's all from me for this video. Thank you for staying all the way to the end of this video, and I hope to see you in the next one. Goodbye.